Thank you very much. Thank you for inviting me. It really is a pleasure, and thank you for your hospitality. Now coming to the not so nice part of the evening, talking about debt crises. As you see, it is a crisis, not crisis, because in my view there is not one European debt crisis, but there are more than one, and we are going to see why. The whole thing, it's coming. The whole thing, the Euro crisis or crises, are enshrouded in myths. Myth about what has happened. Myth one is that crisis in the singular is a misnomer. A, the euro has never been in danger. Because at the beginning, when things started in Greece, it was said that we have to save the euro, we have to bail out Greece, so if we don't do this, the whole thing will crumble. Now what I always say is we had, or you had rather than we, a state in your country where a former Austrian, he later went to Hollywood, was a governor that wasn't always able to pay all its debts, and the US is still existing. The dollar, I understand, is still there. I have some in my pocket, so I hope it's still valid. So the whole talking about we have to save the euro was basically wrong. Second, there is not one but two types of crisis. We have the crisis in Greece, which I would call a crisis like Latin America in the 1980s. What do I mean by that? Very simple. In Latin America in the 80s and in Greece, the government borrowed, the government could not pay its own debts, and this is one type of crisis. The second type are countries like Ireland, Spain, Iceland, or the Asian crisis in the 1990s, and Chile. Chile forgotten nowadays, but in 1982. In that case, the government's finances were absolutely fine. In fact, Spain and Ireland had a better relation debt to GDP than Germany. But then, private banks amassed debts and went bankrupt, and when they went belly up, the government came in and paid out all the creditors, made them whole, socialized debts, so to say. Iceland, you see, is in another color for two reasons. Iceland is not a EU country, and second, Iceland has had a totally different way of managing the crisis. Second wrong point, the insolvency, the non-payment of one single member of the Eurozone would practically be impossible. It had to be avoided. Now this is something we don't talk about any longer, because in Greece you had two haircuts for the private sector, the one not voluntarily, the second, if you wish, voluntarily. You had it in Cyprus, you had it in Spain, so this myth of the euro crisis had practically abolished itself. Then breaking the law was the only way out. What is meant by breaking the law? By breaking the law, I mean that you had to violate the obligation of the treaty that you are not allowed to bail out another one of your member countries. Now, this is, as we will see, very clearly written into the treaty, but together with the other myths, the euro breaks down, the EU breaks down, insolvency has to be avoided at any cost. It is another myth that this was the only thing which one could do. Now, as you see, I'm one who thinks so, but not everyone thinks so. For instance, the Court of Justice of the EU, very much of the EU, thinks that that is okay if you make a bailout with strong conditions. But if we look at the text of Article 125 of Lisbon Treaty, it has now another name, Treaty of the Functioning of the EU, it's absolutely clear. It says shall not, under no circumstances, and there is no, well, it's okay if you have any strong conditions. With or without conditions, it is not allowed. And therefore, unfortunately, in my view, the Court of Justice of the EU itself did not really comply with the law. What could have been done, and would have been needed if you read the text again of Article 125, would be a rule of law-based sovereign insolvency. And of course I have my own model, therefore I have a certain preference for it, which is practically an emulation of the US Chapter 9. I'll come back to this at the end, so I'm just announcing it here at the moment to create suspense, if you wish. And this would of course have been the preferred rule of law type way of solving it. Of course, there's another way to solve it. You could just have had a haircut without any model, without anything else but Greece, for instance, not paying half of what it was due. But this, of course, is not such an elegant and nice thing. Now, what happened, unfortunately, is that the official sector came in and lent massively to Greece and also to the other countries. But Greece is an especially clear example. When the crisis started in Greece, the country had 120% debt GDP, the ratio, roughly. Now, they are about 180% after all 5 years. And the IMF, in its latest publication, said they believe that very soon it will be 200%. So you see, the rescue operation was not really a sounding success, so to say. There is another monetary union, which you know better than I. Yes, they have the dollar, not the euro. And there you also have a no bailout clause, the 11th Amendment, which has always been obeyed and which has never been violated. The EU had, or should have, taken here the US as an example, which unfortunately they didn't. Now, what was the reaction of the EU to the crisis? When the crisis broke, and I had the privilege of being present, incidentally, in Texas, at the University of Austin, where things start to happen, or I think that's the slogan, in this case really so, where Monsieur Yves Le Terme, in his days, he was Prime Minister of Belgium, and as such he was the president of the European Council. In his keynote address told us what had happened when the crisis broke. People like Mrs. Merkel and Mr. Sarkozy were sitting together and being afraid. Now, this is a result you could have had with less payment per head than these guys are receiving. And then he was questioned about the no bailout clause by a particularly bad guy, whom you have the pleasure of seeing today. The question was, don't you think that the law had been violated by bailing out Greece? And he said, as you can read here, that he was of this opinion that what was literally in the law had been violated a bit. I don't know how you violate a bit, but anyway, it was not left unscathed. And he also said that the terror, the fear they were exposed to was so big that they wouldn't even think of talking about making or proposing a haircut for the private sector. The abbreviation PSI means private sector involvement. That sounds very nice. What it means is a haircut. I mean, you lose money. But, politicians always have very nicer words than that. And therefore, they were particularly afraid of the Asians. What do you guess why? It's very simple. Geographically, the exchanges open first in Asia because the day starts there. So the first reactions from the markets would have been from the Asian markets. And I have here, if you are interested, you can also Google it, but if you're interested, the address in the internet, it was, as I said, 2 years ago in the conference in Austin, Texas, where Mr. Le Terme had been speaking. Now, how did it work out in Ireland? Ireland is a bit less known than, for instance, Greece. Greece is much more in the papers. And in Ireland, the claims on the Irish banking system were about 4 times GDP. I'm here quoting from a very well-done paper by Barry Eichengreen, who is about to publish it now at the moment. And the second, bank officers had little practical experience with risk management, lacks internal controls and accountability. This might sound familiar to some people in this country. The IMF, of course, saw it differently. Article 4 consultation means the IMF is regularly visiting its member countries and looking at their economies, pursuant to Article 4 of its statutes. That's why it's called like this. And when they analyzed, so to say, Ireland, they were quite happy about the high professionalism, the high degree of arm's length transactions, etc. in Ireland, which apparently was a fact the IMF could see at that time, but which did not turn out to be totally true. There was a controversy whether to let those face the losses that were the owners of the banks, if I translate this to normal English. And interestingly, the IMF favored a haircut for the owners of the banks, for the senior creditors, etc. As you would normally in the case of an insolvency, 50%, which is quite something. The government of Ireland, and it might not have been difficult to do that, was easy to be convinced by the IMF, but the EU put down its foot and said, no, we will not allow this. Ireland has to guarantee each and every single cent of these claims. They have to to bail out, those who normally, according to economic criteria, would have had to face the losses. And the absence of this burden sharing, that the whole burden was put onto the taxpayers, in the view of Eichengreen, and I see it as he does, is one of the problems in Ireland. The Irish feel they had been overcharged, they had been forced to take up debts which were not literally their debts, but other people's debt, and in particular debts owed to European banks from other European countries, notably German and French banks. Oops. The program for Ireland, Eichengreen writes again, was based on overly optimistic assumptions. This is something the IMF always does. When a crisis breaks, they make projections how the evolution of the GDP, of exports and so on will be in the near future. And they are always what they themselves call in their publications over-optimistic. So they were in Ireland, and so they were in Greece. By the way, I regret to have cut this out because of lack of space, but there's a wonderful graph from Greece where you see the first projection for GDP over time was going up like this. The second was then slightly, but still going up. At the end, they ended up like this, like a Texan saddle, more or less. And within, from one year to the next, so to say, these dramatic changes were occurring. Yeah, senior creditors did not contribute to the banking sector resolution in Ireland, and there was a blanket guarantee by the government. The Irish are paying for this too. And the reason was a concern about cross-border effects, spillovers, as I said, German banks and French banks. Incidentally, the head of the European Central Bank in those days was a certain Monsieur Trichet. As you can guess, he was from one of the two countries that would have been most severely affected, or whose banks would have been most severely affected in the case that there would not have been a bailout by the Irish. Many in Ireland, to read the last lines, many in Ireland question why Irish taxpayers should be the ones covering the costs of addressing the euro crisis, and I think it is understandable that they are unhappy about this. Now you see an expression which you mightn't know, systemic exemption clause. What does it mean? It was invented in the case of Greece, because in the case of Greece, the IMF would normally, according to its own statutes, its own norms, etc., not have had the possibility to give money to Greece. So they came up with a new idea. They said Greece might not be a country fitting, the norms which we have for helping a country, but it's so systemically important. It's so important if Greece falls, the euro falls, the Eurozone falls, Europe falls, whatever. So we have to give money to them. We make an exemption, a systemic exemption in the case of a systemically important country, where, of course, we cannot do anything else but save the world. And you see the same exemption was also applied in Ireland, and checking whether it really applied or not, especially over time, was done with in a bit of a cavalier fashion. The IMF wrote recently about Ireland, unemployment is now down to under 11%, but the pre-crisis average was less than half. So Ireland is not really yet out of the problem, or in Spain, unemployment rates are high, GDP is still lower than it was before the crisis, etc. And any narrative in Europe about the crisis being over in these countries is at least to be doubted, I would say, or you have to be very cautious and skeptical about that. Now, as you see, the excessive deficit procedure is a procedure where you have to agree with Brussels, so to say, with the EU, how to run your budget. Ireland has come out of this yoke, if you wish, but as the IMF itself warns, the crisis might still not be over. It looks better now than it looked, but the crisis is still bending. I have here a quote from a colleague from Ireland who gives a picture as he sees it with the data in Ireland, and you see the situation hasn't really developed in a way that you would say, okay, the crisis is clearly over. We have at least made up, the territory we lost. It is rather not like this. Now, you might think, well, the EU, like in Ireland or in Spain, would always wish to help the big guys, the big investors, and little guys would have to pick up the bill. In Spain, this was not so. In Spain, in Cyprus, small investors, normal savers were losing too, but in Spain with an interesting special treat. Institutional investors, big investors, were allowed to trade, to sell their papers 3 days earlier than the rest. Now, of course, people who know to read and write could see, okay, trading has started, went to the banks and said, I want to sell mine too. But the bank would say, no, you are just not a big trader, you are not an institutional investor, you're a little guy, you have to wait until Friday. And when they were able to sell, they had lost something like half or even more than half of the worth of the traded paper, whereas the big ones who could sell in advance of that came out again in a much better way. So even that, I think, is an indication that the EU, whenever they bail in, as the expression is, the creditors, they also bail them in a very different way. The big ones and the small ones are not treated equally. Now the question is, if you talk of a rescue program, and Brussels always talks of rescue programs of Ireland, of Greece, and so on, how much money is really coming or has come to Greece? You would imagine, if you are rescued, all the benefits are flowing to you. That's why they say you are rescued. But if you look at the money and the flows of money, I have here several estimates. The first and most conservative one is ATTAC, an NGO that is propagating the Tobin tax and debt cuts and so on. And they could show, by going item by item through the accounts, that at least 78% went directly to creditors. Now there are other ones. Varoufakis, I have to say who he is, said more than 90% went directly, again, especially French and German banks, some British banks too. And in the Washington Post, 11% went to Greece. So you see, the money that was freely flowing into the country in a quite, a great flow, did not really go to the Greek. It was practically going directly to the banks that were bailed out in violation of the Maastricht Treaty. And I'm citing FT, the Financial Times. The Financial Times is a rather not too radical newspaper, if I may say that. And they talked of Greece as a slave economy that's being operated to the benefit of creditors. Now, the IMF, post festum, as one would say in Latin, after things have happened, after the milk is on the floor, so to say, found out that it would have been better to have a cut in Greece too. But this cut, unfortunately, could not have happened because the European countries were against earlier debt restructuring. That means haircut, immediate haircut, if you wish, because they thought this should not happen. And the IMF, timid as it always behaves, said, in that case, if you don't want it, we can't do it. And as you have here the quote, the Euro partner ruled out any restructuring of the debt. So the IMF apparently felt unable to convince them to do anything. Now I have here a few more quotes who benefited from Greece. You see the Telegraph, a rather conservative British newspaper, talking about the vulture funds who had a feast, so to say, on Greece, and who saw this as a great possibility, certainly a great possibility to make money. Vulture funds usually, however you call them, are not the little guy, the Greek people who have to be rescued. In Greece at the moment, you have a forced selling of state property. Now, this is an issue you might be in favor or against. You may say, okay, the state should not operate anything, or should be privately operated. You may say the state should operate certain things, public transport or whatever, and this should not be in private hands. But if you sell at this time in Greece under pressure to sell quickly, then of course the prices you get foreseeably will be well below value. So again, this leads to the fact that some people who can buy cheaply will also get a lot of money out of it at the cost of the Greek budget, of the Greek people. But this is one of the conditions of the Troika. The Troika are the people who run Greece at the moment. This Troika, is three, always. 3 horses, normally. Could be 3 donkeys in that case, I don't know. But anyway, it's the IMF, it's the European Central Bank, and it is the European Commission. And the second point which Zettelmeier and others have commented and criticized is that the haircut, which was forced onto creditors, was excessively sweet. Now you may ask, how can you force a haircut on creditors? Well, Greece could, because in the day of the crisis, and before the crisis of course, more than 90% of the debt of Greece was under Greek law. Now, if you are the debtor and the lawmaker, so to say, you can simply legislate a new obligation law in which you introduce things that are useful to you. For instance, the Greek introduced collective action clauses so that a majority of creditors, if they voted for, then they could also bind the rest that was voting against. And the Greek used this to enforce the first haircut. But as you see, the cash sweetener was a multiple of the average of many transactions over the history of that crisis, and to the point that Zettelmeier and others were afraid that the Greek deal as a precedent might make it difficult if the necessity comes up in another country to negotiate a deal as well, because creditors will expect to get at least as sweet a piece of cake as they have gotten in Greece. The interesting thing is you have neoliberal crisis as a pretext for further enhancing neoliberalism. Why are the neoliberal crises? Because they were caused by deregulation and liberalization. it was liberalized. Banks could free of the shackles of norms and regulations, could increase the business volume to the point that that's the most extreme point. In Iceland, 3 banks, I repeat, 3 banks, amassed a volume of 10 times the GDP of the country. This is quite a bit. Imagine what it would be in the USA if 3 banks had 10 times the GDP of the country. And then, of course, these business models, which, as we have seen in the case of Ireland, were not always as well and deliberately done as one would have thought at the beginning, started to crumble, and in came the taxpayer and had to pick up the bill. Now, you would think if that is so, then of course you will change the policies, but you wouldn't. And I always refer to Jamie Galbraith in that case. He wrote the book, The Predator State, where he says some group of people were able to if you take someone prisoner, to take the state prisoner and use the state apparatus to draw out money for themselves. Now the case of Iceland. As I said, it's an interesting case, and as you see, the IMF presented it as a success. Now, what did Iceland do? Iceland had the crisis in 2008, and in 2011, they had access to capital markets again. So that is, if you compare Greece, still not having access to capital markets, it's quite an achievement. They had capital controls. I mean, they had all the things which you shouldn't have, according to the IMF and according to the EU. They had capital controls. They had referenda, 2 of them, a fiscal policy not tightening during the crisis, at least in the first year of program, no reduction of social expenditure during the crisis, using inbuilt stabilizers, so to say, and this was, in the end, a very successful situation. I don't know whether you see the graph very well, but you see the the blue line above are total social expenditures, and you see they increased in the crisis as percentages of GDP. Of course, GDP fell, meaning that real outlays did not increase. They went back a bit, but it's a totally atypical picture, because normally in all the other crisis countries in Europe, like in Latin America in the 80s, etc., you had social expenditures going down. Public health expenditure, to give one example, between 2008 and 2012 went from 7.22% of GDP to 6.99% of GDP. You see, this is just health expenditure, not total social expenditure. It was nearly stable. Not quite stable, but nearly stable in percentages of GDP. I have here a very interesting quote from a report written by the independent expert on debt and human rights. This is the short title of the United Nations. In the whole title are 2 or 3 lines, so I don't remember it and record it at the moment. Who looked into invited by the Icelandic government, and so to say checked what had happened in Iceland. And he says, when the economy contracted, in real terms, painful cuts had to be made. People had to work overtime without being paid. People had to take losses in income. But all in all, healthcare, education, etc., were as much as possible preserved by the government. 2007, you see, central government debt was much lower than the crisis. You can see the traces of the crisis. It went up to a bit more than 100 in 2030. One reason why it shoot up like this was also because about a third had been in foreign currency. So when the Icelandic krona devalued, of course, the debt in its own currency increased as well. Now, in 2010, the Supreme Court determined that foreign currency indexed loans, which Icelandic banks, like in many countries in Europe, had offered to people, for buying, for instance, houses, etc., were illegal, meaning the consumers were protected, and savings deposits of Icelandic customers were saved. Well, saving should be saved, I think, and also small businesses, small local businesses. They lost something, but they were kept alive by the government. Now, who lost something, you will ask? Well, they took the three banks, separated them, each of them, into a domestic sector, so to say, which had Icelandic customers, clients, and in the foreign sector, which was the sector that amassed this huge volume of transactions, basically with foreigners, especially British and Dutch foreigners. And while the domestic part was saved, there was a new bank we put there, the part of the claims of the foreigners were just not paid. Because it was not the debt of the government, it was no default. It was the debt of the banks, and the banks, they had gone belly up, so that was it. And this is also totally different from the situation in Ireland, as we have seen. Ireland and Iceland is a big difference. They even had an institution called Welfare Watch, that was looking whether welfare was deteriorating too much, was advising the state what to do against it. And what I like in particular is this quote from the speech of the President of Ireland, which he gave in Geneva at UNCTAD, where he said, basically, there is a question, what should prevail in a democracy if a conflict of interest arises, the interests of financial sector or the will of the people? Now, to him, this was not a question like the first question, should you pick up the bill for the speculation of your private banks? Now, very quickly, because I'm already running over time otherwise, what is the emulation of Chapter 9, the Raffer proposal, which I advertised already? First, you have some kind of insolvency procedure, and the role of the court would have to be taken over by an impartial arbitration panel or a court of arbitration, which would be rule of law conform. Chapter 9 in the US is, of course, not for sovereigns, as any lawyer will tell you, but it is for municipalities, meaning debtors that have governmental powers. So the same problem comes up which you have with a sovereign state. To what extent can the court or could creditors intervene into the governmental sphere of the debtor? And the answer the Americans give is very clear. Paragraph 904 says not at all. The court depends on the volition of the debtor and cannot go beyond that. Protecting debtors and democracy by protecting certain essential social expenditures, as was done in Iceland, I might say. A right to be heard of the people, of course by representation in the country, so that they can voice their view about the deals which the government is making with the creditors. Fair and equal treatment of all creditors. This is the point that makes me in particular popular with the EU and the IMF, because what it really means is no illegal preferential treatment of the official sector. The IMF, the European Central Bank, whoever would have to suffer the same haircuts as the private sector. All creditors treated equally. For the official sector and official sector creditors, this is too much of equality and makes me so popular, therefore. I think that this open process would lead to an improved sustainability, and I'm not going into the optional point, it's a bit technical, but I just usually mention it. If you wish, we can go into it during the discussion. Now, I am ending with a quote from Paul Krugman. Paul Krugman, as you see, wrote it for one particular country which also participated in the European debt crisis, Cyprus. And he means and writes that it would be nice if political decision makers could actually learn. And I cannot but agree with him. It would be nice. The problem is, would they learn? And here I'm a bit skeptical, but he isn't too positive either, if you read the quote. Thank you. I think the mic is coming.
The quote about how far can the state go to bail out these private banks. So to bring it back to America for all of our students, isn't that in fact this idea of socializing private losses? Isn't that what we did in 2008 when we passed a trillion dollar bank bailout where our tax dollars are going to pay off these private banks? And do you think that was a good idea, or was it true that they were too big to fail?
Well, I think, I'll go back to here. I think no one is in the end too big to fail. There are mechanisms what you can do. For instance, in Sweden, I mean, Sweden is of course much smaller, but when they had a banking crisis, they were quite radical, in intervening into the banking sector. But nevertheless, and at the peril of making myself unpopular, I think the TARP which you had was much better than what the EU did, because the TARP earned profits for the Treasury. The European programs earned no profits for our treasuries, for our Ministry of Finance. So I think, all in all, the American way of attacking the problem, there are points which one might criticize, was much better than what the Europeans did. Much better. There are weak points too. For instance, I think the moment was not used to be able to introduce more control of the banking sector, and the banks nowadays are practically behaving as they had before the crisis. So there are some things, but from the purely financial point of view, I would be happy if we had had a troubled asset relief program instead of what we have.
I'd like you to compare what you think would have happened had Greece taken the same action as Iceland did and said, no, we're not going to stay in the EU, we're going to go out the way Iceland did.
No, you see, yes, there are 2 points which are not connected. First, if you go bankrupt, you can still in the EU. Bankrupt, you can still stay in the EU. In fact, Greece is not only a member of the EU, but also of the Eurozone, having the common currency. And the wonderful thing from this point of view, if you wish, and the Greek wish to stay in the Eurozone, that's from right to left, there's a unanimous belief that they have to stay or they would like to stay in the Eurozone, you cannot be excluded. It's a bit like, a class where in whichever way someone misbehaves, you can't kick him out. Because when they wrote the treaties, they had no clause that would allow you to kick one member country of the Eurozone out. So going into bankruptcy or not paying maybe a so-called unilateral offer, like for instance Iceland or like for instance Argentina, would have been possible. They would have had less debt, they would be viable, and it would have been better for practically anything. In April 2010, the then chief economist of the Deutsche Bank co-authored a paper in which he proposed Greece, 50% of debt to go. The rest of the 50%, economists call this a trade-off, has to be guaranteed by the public sector so that the banks wouldn't lose additionally further money. And the authors were very clear. They didn't say the Eurozone members, but they said those members that can afford to do it. In those days, France and Germany. I mean, a very clear and down-to-earth point. And if that had been implemented, for instance, that would have meant Greece would have had 60% debt to GDP. They could have managed it. And the private sector would have lost 50%. In the actual haircut, they lost more. Now, the estimates vary, but no estimate is below 55. So it would have been better for Greece too. It would for nearly anyone, it would have been better. Politicians, of course, that gained in importance, the Troika, that's becoming important in Greece, and a couple of vulture funds, but for all the rest would have been better off. And of course, if they had had a proper insolvency procedure as I propose it, it might have been only 40% loss, and Greece would have been afloat. So this way or that way, what was chosen to do by the EU under fear, as Mr. Leterme said, was the worst possible choice you could do.
So I have a question for you. Would the U.S. benefit from Iceland's recovery plan?
What do you mean with Iceland recovery plan?
Primarily dealing with the banking situation. I mean, do you think our banking, do you think it's reached?
Well, it's very simple. They said we are not going to pick up the debts of our banks towards foreigners. The first thing which the president said, should the people pick up the debts of the private banks? And the answer was no. There were 2 referenda in Iceland, and on both occasions the people said no. So Iceland said, we're not going to pay. They paid a bit, very little, but basically they didn't pay. There was a huge storm against Ireland by the Dutch and by the British, to the point, the ridiculous point, that the British used the anti-terror legislation because of this banking crisis against Iceland, but they could not extract money. And the Court of the European Free Trade Association, of which Iceland is also a member, like the EU countries, but Iceland, as you know, is not a member of the EU, they found that Iceland was absolutely justified, had the right not to pay the British and the Dutch. Because, just a moment, the point was, of course, these banks had established their own daughter firms, so to say, in the Netherlands and in Britain. And if you incorporate a firm in a country, then of course the corporation is a corporation of this country, a British or a Dutch corporation, and is therefore covered by the insurance schemes for savers, like FDIC in the States. So what happened was the British paid an officially British company, or the victims of an officially British company, the money that was due to them, and the same in the Netherlands. And then they turned to Iceland and said, now give us please this money back. And Iceland said, no, why should I? And they were able to persevere and to be given right by in this arbitration process.
My question is that you have really, it seems like in a place like Greece, for example, a whole generation of people who are going to have their lives, or have had their lives destroyed. And that last quote that you had up there from Krugman was very interesting to me. Why this vast social experiment, we're watching this take place in Europe, and people aren't learning from it, or politicians aren't learning from it? And is ideology that powerful? I mean, what is preventing the people from saying, well, you know, I need to change my mind. We have new evidence here about what we should do in these situations.
Well, that's a good question, but another question is, do politicians really want to learn? Because, you see, there is also another agenda. There might be another agenda behind it. Danny Roderick, in the Journal of Economic Literature some years ago, wrote an interesting article on reforms, in which he basically writes, debt crises have been taken as a possibility, seized as a possibility to do some totally other things, to clear, so to say, away any policy one wouldn't like, whether it was the cause of the crisis or not, to introduce a particular policy which is liked by, say, the IMF, by the European Central Bank, etc. And if you look at it this way, in Europe, then of course you have an explanation. Because the debt crisis is used to make absolutely neoliberal reforms. To cut down the state in Greece, to sell state property at fire sale prices, to introduce totally new legislation, consumer protection, workers' protection, and so on, because you have to do something against the crisis. And in that respect, of course, it's totally irrelevant whether the crisis, to what extent the crisis really is the reason. Now, you could, of course, argue in the case of Greece, the way the government behaved was the cause of the crisis, and this is, of course, right. In the case of Ireland and Spain, it was totally not so. So in Ireland and in Spain, you had, or the EU is fixing something that wasn't broke, because government finances, government behavior was absolutely, from a financial point of view, okay. But even there, you could introduce these reforms. That's why I referred to Jamie and his predator state, that some small groups of people have kidnapped the states and are used as a state and using the apparatus of the state to further their own objectives. If you put it in one word, you can just say greed.
Along those lines, did the equity ownership of the banks in Iceland and Ireland change during the process of the creditors getting cut back, or did that stay the same and they get kept whole?
No, it was different. And this is why Krugman said Ireland should have done in Iceland, so to say. In Iceland, equity was wiped out. And the domestic part that was saved, went totally into to other owners, to the state. But I mean, property wasn't there any longer. If 3 banks have 10 times the GDP, then you can net out how much net value still is in this enterprise. I mean, it's very easy, you don't have to calculate. In the case of Ireland, the owners of the banks were kept totally unscathed.
I have one question. You said earlier to Professor Kelly's comment that the banks, we didn't use the crisis as a way to re-regulate the banks and control them.
One should have, yes.
Yeah, and they're back to doing basically what they were doing before the crisis. Does that mean you see a new crisis on the horizon, or the potential for a new crisis?
The potential, definitely. But you see, for instance, quantitative easing, so popular with many central banks. The ECB is now letting money flow out, at unprecedented volumes, practically at zero interest. I mean, it's very similar. And where is it going? It's not going into the real economy. Banks use it to speculate again, to play games in the derivatives markets, etc. So, as it was before the crisis.
So how long do you think it'll take for another crisis?
That's difficult to say, but if we are lucky, there might not be another crisis, but the potential is rather dangerous, I would say, that we would see another crisis. Could be.
Some have alleged that one of the major problems for the Greek government, there's a deeply rooted practice of tax evasion, and that the collections are abysmally low. And what do you think of that allegation, and is Greece unique in this respect?
Well, a certain dislike of taxes, I think, is rather universal. But you are right, in Greece it's particularly great. Historians say it goes back to the days when Greece did not exist yet, and the Greeks were under Ottoman regime, and they didn't want to pay the Turks, so to say, their money. But anyway, it's very strong in Greece. You have some extra, chocolates, so to say. For instance, ship owners are not supposed to pay taxes according to the constitution, meaning that cannot be changed very easily. But in this situation, the Greek government made one decision, in my view. If you can't raise the money you need by taxing, or you don't want to for whatever reason, but you can get cheap money, then you get cheap money. And by entering the Eurozone with falsified data, by the way, as we know, and as the EU knew at that time when they entered, and they were happy to have a new member, they could all of a sudden get money at practically very, very cheap interest rates, below market interest rates. A real market interest rate for a real Greek risk would have been much higher, which would, of course, have reined in the amount of money they would have been able to raise. But within the EU and with the help of the EU, it was easy, because the EU said, basically, any Eurozone member country is no risk. Just fun, no risk. And not only that, when Basel II made some slight changes and said, okay, not every OECD country has a zero risk weight, meaning you don't need to have a single dollar if you, for instance, lend $1 million to this client, because it's such a secure client that you don't need any money underlying, so to say, your claim. But the EU said no. A member of the Eurozone that has debts in its own currency doesn't need to have a capital weight. Otherwise, Greece would have had a very small but a capital weight after Basel II. The EU in a directive changed this back to zero. But not only that, As you know, any bank normally is subject to an excess, to a limit, how much you can lend to one single customer. 25%, whatever. Depends a bit on the regulators, on the country where you're in. And this was waived as well by the EU for the Eurozone member countries. So you could, in principle, give billions of trillions or whatever to Greece if you wanted without having a single euro in that case on, as a down payment, so to say, as a security in your own pocket. And that, of course, is a totally catastrophic situation, which for Greece was very nice. You know, they could get the money easily, they could get it cheaply. Banks, to some extent, considered Greece as a German risk, meaning no risk, with a Greek interest rate. Now, the Greek interest rate was not very great, but a few basis points, meaning hundreds of percent, more than the German ones, the German bonds you would get. And so they went into Greek papers, which was, of course, good for the Greek government because it took away the pressure from them that they would have to reform the tax system.
I wanted to just kind of look in on this joke I came across. It was that a young man visits the Australian consulate.
Could you speak up a bit, please?
A young man visits the Australian consulate in Athens, and he asks for a work visa. Why do you want to leave Greece? Asks the official. For two reasons, replies the Greek man. First, I am worried that Greece will leave the EU, which will lead to new poverty and chaos in the country. The official interrupts him and says that this is nonsense. Greece will remain in the EU and submit to financial discipline. Well, responds the Greek colony, this is my second reason. So, how accurate would you kind of view that as far as, I mean, it was funny, but, you know.
Well, I think it's a story, but, I mean, Greece had a big problem as it comes to government efficiency. For instance, a colleague who was one of the advisors of Papandreou told me the following thing. When he came to Greece and he looked into social security files, so to say, they were still in the old way, which, well, most of you, the young ones, wouldn't know. But when I was a student, for instance, in the library, we didn't have a computer, but we had these small cards, you know, the one after the other. So if you were looking for a name, whatever, you would go M-A-M-A-N and so on until you were at whatever Manning or so through the cards, and which means, of course, that what you couldn't do with this system is you couldn't practically check whether all payments were okay, whether, for instance, there were too many people aged more than 100 years in Athens. Because to do that, you would have to go through each and every of these papers, these cards, would have put down the age, etc., address, and then at the end you would have to add up, etc. It's not in a normal, modern administration. You just press a button and out comes the result. So many people in Athens are older than 100 years. Then I could say, well, wait a minute, it's not my experience when I go through the town, there must be something wrong, we have to check whether these people are really alive still, etc. But you couldn't check it, it was impossible. So the reforms that the Troika demanded from Greece at the beginning were at this time impossible to make because it didn't have the tools to check. I mean, you can check, of course, with the card system too, but till you have checked everything, you are dead, probably. Definitely retired if you are young when you start. So the first condition would have been to give Greece the possibility to check what was wrong in the system, to give them the modern tools which are needed to analyze, for instance, an administrative system, which they didn't have. And what then followed were the cuts, including cuts, for instance, with those people who were chasing people who didn't pay their taxes. To the point that Greece had a certain amount, I forgot now the precise number, of debts from their non-taxpayers, so to say, the tax sinners, that they couldn't collect because they hadn't got the people to go to the court to do the legal procedures to just seize it. And this, of course, is a very counterproductive thing.
Okay, one more?
Yeah, Greece 26 bankers in jail recently. Don't you think we can improve our situation by doing the same in the U.S.?
Yeah, I think Iceland did it. No, Iceland did it. Iceland had legal procedures even against the prime minister and investigations up to the president. Of these people, bankers too, who were involved, and it was checked whether there was any criminal behavior going on, etc. And the prime minister was actually indicted. Now the case is not closed yet because he appealed to the European Court of Human Rights. But in Iceland, so to say, the highest court had practically indicted him. But if you're a member in Europe of the European Convention on Human Rights, then anyone who claims that his or her human rights are being violated can go to this court. And that, of course, takes some time, because till this court works on it, so at the moment it's pending still. But in Iceland, they did it. Also bankers were... Yeah, and I think that should have been done somewhere else too.
With the derivatives based on owning mortgages in the United States.
Well, or for instance, fraudulent loans.
Yeah.
In the United States, at the time of the savings and loans, this was still done. And now it isn't done. But I forgot how many, I think 600 individuals and 300 entities, SNL entities, were actually taken to court, and most of them were indicted, as far as I recall. But these were the savings and loan crisis, that's quite some years ago.
Okay, thank you all for coming this evening. We have sign-in sheets for the students. Let's get to it.
Thank you.